So Fed Chair Jerome Powell announced rate hikes today. That's 25 basis points or a 0.25%. And in fact, this is sort of what we've been talking about the last week that looked like was going to be. If you go back a couple weeks ago, though, the talk was 50 basis points rate hike, which ended up not being the case. And the basic reason was that we've had a banking crisis, so that changed the perspective on everything. Now I'm in Korea and I was following the news 2 a.m. in the morning kind of thing, like really early in the morning for us. And one of the things I want to share with you guys is that when I was, glancing at my phone in bed, I was still asleep and seeing what's going on. The first sort of thing I read was like, wait, they're not raising rates? That's sort of the impression I got from CNBC. And then later out through the day, it felt like CNBC was pumping and ultimately was basically giving people bad information. And I share that and open with that because I feel like there's going to be a lot of bad information out there. Because frankly, there's a couple camps. There's some people who don't want to tell you the truth, or some people that frankly don't know what it is. And I want to show you my particular version of this thing, and I feel like it is the truth, but I try my best. So let's just jump right in, and I'll tell you guys sort of what I'm talking about here. So first is, let's take a look at the headlines together. Stocks slide following Fed's rate hike. Dow sheds more than 500 points. Live update. So that's at the end of the close. However, if you go around midday, this is when CNBC was in full pumping mode, and the headlines were reading, Fed hikes rates by 0.25 percentage point, indicates increases are near an end, and the market was up. And I remember I was in bed and I read that. I was like, oh, okay, so I guess everything's going up. That's the impression you would get from CNBC, right? And if you take a look as well, it was the market was right around here, around 2 p.m. And this is during the Fed announcement, and things were up. And obviously you can see what happened where the market ended up tanking today, right? So this is why I say there's a lot of bad information out there. So you got to be careful. And moreover, I feel like the fervor in the market, the crazy fervor, right? Sort of your retail, meme stock kind of stuff, I guess is still here until this stuff is gone. I don't think the bubble is over. That's my opinion. Because this GameStop was up 35% on the day that they announced that they made a little bit of money. And people were like, oh my God, it's going to go to $1 bazillion a share. So we'll see how that, this is true, guys. You can make money trading this stuff, but I wouldn't be thinking this is long-term investment. That's not a crazy thing to say. So do be careful. Yes, you can make money, but it's trade. Same with First Republic. This is a crazy one. It is down 15% on the day. And this one has been up double digits every single day this week and has been a really, really interesting one. So you can write in the comments if you've been making money on GameStop or First Republic. My opinion on these things, just yes, you can trade them, but I wouldn't necessarily count on anything in either direction. Just be very, very careful. The other thing is, too, is you talk about Jim Cramer. He's saying, invite me to your funeral. That's what they're really saying. And the basic idea is he's saying if you bet against the NASDAQ, you're going to lose. Invite me to your funeral. That's sort of what it is. Put that all together with CNBC telling you everything's great and the markets, are pumping around 2 p.m. And then people start to listen to what Jerome Powell had to say. Basically, I watched a bit of his speech. I saw the Q&A, and this is how I felt. My overall impression was, I don't feel confident. That was my overall impression. This was very, very different in the past where Jay Powell comes out as a calm and collected guy. We got everything under control. We're watching the data. In this particular performance, I was just like, I don't think they know what they're doing. That was my overall impression. And the Fed, their goal is essentially they want to have everyone have jobs and they want to keep, prices stable, right? Not things going too crazy one way or the other. And also, too, to sort of give you a rosy scenario until everything is okay. Here's the headlines, though. Fed raises rates, nods to greater uncertainty after baking stress, right? So that was sort of the key, the uncertainty. Also, too, you can read more. Federal Reserve presses ahead with quarter-point rise despite banking turmoil, right? This is what it's all about. And Fed stresses commitment to cooling prices as Fed hikes rates. They continue to, say, hey, we want to get it to 2%. We're talking about inflation. The current Fed projections is maybe inflation will go down to 3.3 by the end of the year. Again, they are always giving you the rosiest scenarios, so I'm just giving you an idea. But yeah, there's a chance it'll come down. Here's a big however, which sort of throws a wrench into the whole thing, and a lot of people aren't going to be talking about it. Actually, let me show the headlines here. It's actually the UK. Their inflation went up, which is a U-turn here. UK inflation swings upward in a U-turn. No one had expected that, I guess, and this is something I didn't expect either. I'm like, what? And so it's funny because that's why I always tell you guys when people don't necessarily give you bad information or don't give you good information is because either they don't know it, meaning they don't even bring up the UK thing, or they know it but don't talk about it. I try to give you everything that I possibly find and tell you the most important stuff. So I think this is actually a big thing. So the UK, they're at 10.4%. Again, that's a reversal of what was previously a downtrend. Now, if you go over to CNBC, they're going to say, hey, Treasury will do whatever it takes to ensure savings remain safe. And that's Yellen was speaking in front of senators, and that was at 1:41 p.m. And again, it was at 2 p.m. They were telling everyone that the Fed maybe not going to raise rates anymore. The thing is that what was kind of weird about today is that they had the scheduling was that Yellen was speaking today and Fed Chair Powell on the rate hikes at the same time, the same day, which is a bit odd. And I think probably what's going to happen is probably most of the channels out there, be it YouTube or on TV, are just going to talk about Powell, but not talk about Yellen. And I would argue that Yellen's probably more important right now, given the banking situation. So what are the stuff that she said? So here they're trying to say that everything is going to be okay. Savings remain safe, right? That's sort of what they're telling retail investors at 1:41 p.m. and CNBC's doing the pump and stuff. But then you go later, he says banks drive stocks lower after Yellen's remarks. Okay, now we actually listen to her. Okay, crap. Now things don't look so good. And then this was the key. U.S. not considering blanket insurance for bank deposits. Not considering. And this is something that I had mentioned to you guys before. There's a couple key points. Janet Yellen was giving a speech, I think it was yesterday or 2 days ago, in front of all of the bankers, lobbyists. True story. It was like the American Bankers Association and and everything. It was fine. And there was also something as well. It was we looked at it together. It was a couple days ago. There was like the vice president of one of these small bank associations saying, "Hey, we're a bit concerned because we think the government is going to preference all of the benefits and favors to the big banks and leave the small banks out in the cold." And I kind of think that's where it's going. So I'm on the small banks on this one. I think that's kind of where it's going. I also think it's a big move towards sort of the big money trying to buy up the smaller money. It's always what it happens at, and at a discount and with support of taxpayer dollars. It's kind of like what's going on in Switzerland. So I mentioned you guys with the UBS and the Credit Suisse thing and the bondholders getting wiped out, and then each person being on the hook for $13.5 thousand. So understand what's going on. I'm trying my best, guys, to explain to you, and it is complicated. I won't lie to you. If you take a look at like this, for example, this is the Fed funds target rate. So everyone's predicting that interest rates will probably come down, but that's like a couple of years from now. If I had to bet, is because sometimes the market's like, hey, they're gonna pivot and start cutting rates now. I've never said that. The Fed has never said that either. So whenever anyone who comes up and says that, I always find it really strange. But the banking thing could change the equation of everything. And I think to be fair to Jay Powell, this whole banking thing threw a wrench into them as well. However, if you looked at what we talked about yesterday, I guess there were people at the Fed who were warning SVB about the problems, and people did know about the problems at the bank. So that's kind of be a real, so what's the right word to say, sensitive topic for them, because obviously it makes them look bad and they lose credibility. Although, people always joke in the comments, wait, what? Did the Fed have credibility at all? Who knows? This is another thing I want you guys to show you as well. Where could inflation be? So these are, again, some forecasts, but always take this stuff with a grain of salt. So yes, inflation is likely going to come down. I would agree with that. It can't stay, crazy high forever, but it doesn't necessarily mean it's going to fall down that quickly. Again, the Fed was saying maybe 3.3% by the end of the year, but they give you the rosiest scenario possible. So maybe end up being higher. But on this chart, you're looking at the Fed, hitting their target 2% like by 2026 kind of thing. The labor market's been funky. Unemployment still remains low according to the numbers. I say according to numbers because there's a caveat there. But chances are we need unemployment to go above 4%. Now, the basic gist of it, though, as I say, pay attention to the numbers a little bit caveat, is because there are people who essentially dropped out of the workforce, or people who work a couple of jobs, or people who are working, but it's not necessarily in the job that they want. So, for example, if you get fired from Goldman and you were making, let's say, $200 a year, and then you get a job at, say, Uber, for example, and you're making, 10 a year or whatever you're making, you're employed, but it's not like you're actually making enough money to, survive. So this is the dot plot. If you don't know what this is, so this is basically they do it anonymously. People were at the Fed. They basically predict where they think the Fed funds rate is going to be, so where interest rate is going to be. So they do think it is going to come down, but like if you look at this here, this is 2024. They're starting to predict, but it's all over the map. So some people at the Fed say maybe we're not going to cut. Other ones say they're going to cut, and you guys decide what you want with that. But basically, you're looking around maybe a 4% Fed's fund rate in 2024, and then maybe like 3% in 2025, if they do hold their projections. So again, this is just everything is based on projections, but for this year, it doesn't seem like they're going to be cutting, and also too, we're worried about the bank thing. I think this commercial real estate market is going to be a real problem. We know that people are working from home, okay? So that means that less people are going into the office, and that means that these, companies don't need that office space. We also know there's many companies that were essentially, be it New York or San Francisco, that were sort of your startup kind of companies to this kind of thing. We know that rents were going up there, during the period, and there was essentially a big bubble. And essentially what's going on, I use the example of Twitter, is you have these companies that aren't paying their landlords, and then their landlords who, went way over leveraged to build a whole bunch of commercial, or they have mortgages and these kind of things. They're defaulting, which is a real big problem, right? And it causes a cascade. Now, moreover, if you go talk about the First Republic kind of thing, so the small banks, they're the ones who have all of these sort of commercial real estate loans. You can see here. So this is commercial real estate, and this numbers we've seen other numbers before, but a lot of the loans, this one's saying 67% are essentially with small banks. So I think this is sort of where the First Republic is our kind of struggle. So no one really knows what's going to happen with this, because essentially, ultimately, if you have this basically where everyone's borrowing money and one party decides not to pay, then the next party can't pay and the next party can't pay. Who's left holding the banks? And it could be commercial, the banks who hold the commercial real estate, right, mortgages. Now, the thing is that with the First Republic, we read a report, it was just yesterday, that I guess people were pulling out deposits like crazy, and it was like half the deposits had left. And this is when was vulnerable. It was the same situation as well with like Silicon Valley Bank, where people started pulling their money out of the bank, right? So the issue is that the banks generally don't have everyone's money. That's how it works, is where you deposit your money, the banks then lend it out and do whatever they're going to do with the money, or put it in a bunch of long dated bonds or whatever. But they actually don't have everyone's money if everyone starts pulling out, essentially, hence bank run. And this is something that the government, which obviously they should be concerned, and we all should be concerned about, like, okay, what happens if everyone loses faith in the system, and we all start pulling our money out, right? This isn't collapses. Now, I don't think necessarily that everything is going to collapse and we're all going to die. I'm not saying that whatsoever. What I do say always, though, is manage your risk. Because right now, I don't think it's crazy to have, multiple bank accounts. It's not a crazy thing. It's not crazy to have different multiple, asset classes. And more importantly, though, I think if you have to ask me, I would say the two most important things right now would be making sure that you're securing your job and paying down your debts, because interest rates continue to go up. This is something that they don't talk enough about on other channels. I'm just being honest with you guys, and I think they should, and I'm telling you. So you can read here. Here's the headline. Gen Z is racking up credit card debt faster than any generation. And essentially, people's debts are going up, but Gen Z is the one who seems to be going up the most. There's a couple ones here. So this is the change in debt. So Gen Z went up 5.9%. Although the aggregate average debt that Gen Z has is about $2.7 thousand, $2,700. Okay. And then the highest is Gen X at 8,200. Then you have the silent generation at about 5,600. Baby boomers at 7,400, and millennials. And this is average credit card debt at around 5,800. So everyone's debt levels are going up. And this is something that I've been watching. I've been watching the commercial real estate market, and also too consumer debt levels. Now, consumer debt levels are important because if people essentially, rates get too high and they lose their job, et cetera, then they can't pay their mortgage, they can't pay their car payment, they can't pay the real estate thing. And, in those situations, they're not going to go out and buy a new iPhone. And if they're not going to go out and buy, say, for example, a new iPhone, then Apple doesn't make money. It says, see, do you understand how all of these things are connected? And then you also have the issue as well is, let's say in this situation that restaurants can't get enough workers, they have to pay people a bunch more money. And then because they have to pay people more money, they start raising prices at restaurants, and people are losing jobs, and they're not going to go to the restaurant. So this is why I track multiple things. I don't think inflation is necessarily going to come down quickly right away. But I don't necessarily think everything's going to crash like crazy. Because if you protect yourself, okay, again, pay off your debts, have a good job, and if you do want to be investing, right, just manage risk. I think that's fine. You're going to be okay, because one thing that I've been noticing a lot is that just a lot of people out there really, really stressing out. You'll see it on TV, you'll see it on YouTube. That's because, frankly, they probably made very, very large bets in things and are just like hanging on every word that the Fed says, or hanging on every word that Elon Musk says, and these kind of things. And it can be quite nerve-wracking. And this is sort of why I want you guys to come in with a balanced point of view on these things. Take a holistic, think about your life, and don't just bet on one thing, because, for example, if you bet everything on GameStop right now, or First Republic, or what the markets are going to do, you may be disappointed on a daily basis, and that's tough on your health. So that's my opinion on that. So anyway, I'd love to hear your thoughts on anything that we talked about today. Again, Fed said 25 basis point increase, and Yellen saying we're not going to necessarily protect everyone. That's sort of what I got from that. And markets are down today. So thanks again for watching, everyone, and I'll catch you next video.